Chapter. My name is Jay Coulter, and joining me for this episode is Nancy Davis, the CIO and founder of Quadratic Capital.
Our mission at Resilient Advisor is to have a significant impact on the retirement crisis by educating and empowering financial advisors to better serve their clients. We bring you industry thought leaders and experts to help you make a difference in the lives of your clients.
So Nancy, I have botched lots of first names and last names when doing intros to the show. I think I might have botched the name of your firm. It's Quadratic Capital in the intro. I appreciate you coming on. This is your first time on the show. Would you please tell listeners and viewers a little bit about yourself?
Well, thanks so much, Jay, for having me on your show. It's really a pleasure. My name's Nancy Davis. I'm the founder of Quadratic Capital. I started the firm in 2013. And prior to that, I spent most of my career at Goldman Sachs. I was there for about a decade.
Excellent. And you are an industry expert and thought leader on all things derivatives and fixed income. I'm looking forward to this conversation because as portfolio managers and financial advisors build solutions for their clients, it really is the biggest pain point in their portfolio construction process. Let me start with the biggest question of the day. What is your outlook on inflation?
So I know a lot of people come probably on your show and pontificate about what they think is going to happen in the future. I'm not one of those people. I don't know what's going to happen in the future. I have no idea what's going to happen in the future. I just know, my expertise is looking at probability distributions and what's priced in. And I do think, some parts of the market are priced for inflation, whether it's commodities that have seen tons of appreciation or certain cyclical equities, and even some portions of the TIPS market. Those are the treasuries with inflation protection, but other parts of the market seem like a really good value. And I just think at the end of the day, people really shouldn't try to make a bet about what they think is going to, whether it's going to be inflation, deflation, stagflation, recession, something else. I think it's just everybody needs portfolio diversification, and inflation is one of those things that tends to be really underweight because we haven't had runaway inflation since the 70s.
Wow, this is unique. A portfolio manager coming on, not giving an opinion saying there is no inflation or there is inflation. And really for financial advisors, for operators constructing portfolios, it's important to account for it all, correct?
Yeah, I think you just have to be prepared. And I think that's where portfolio diversification is super important. I think a lot of financial advisors use passive fixed income funds, like, for instance, the Barclays Ag Index. That's kind of considered core fixed income. And I don't think a lot of advisors know that the Barclays Ag Index is actually short volatility. That's because of the mortgage exposure. And I also don't think they necessarily realize that while about 40% of the ag is treasuries, there's no inflation protection in the ag. It's probably because it used to be the Lehman Ag, and it was probably created before the US Treasury invented the TIPS market in the late 90s. But I think it's just one of those things that if you want to have a diversified fixed income portfolio, why would you not make it really diversified? Why take a side?
Yeah, I tell you, I did not know that TIPS were not in the ag until I started prepping for the show. And I've been in the business for 25 years and spent a decade in fixed income. So when you look at portfolio construction today as a financial advisor, the general dogma that I see is to go and shorten up your duration to help mitigate risk in a portfolio. And I've seen some of the work that you've put out where it states that that's not necessarily the best idea, and there are unknown risks to most advisors when they do that. Tell us, what are your thoughts on short duration as the only risk mitigator in a portfolio?
Well, I think short duration does help mitigate, interest rate risk, but short duration is a bit of a misnamed strategy. It really should be called less long, because with a short duration fund, you're still long duration, right? You're still guaranteeing that your investors will lose money in a higher yield environment. They're just going to lose less money. So it's not really short anything, which has always kind of bothered me about the strategy name. It should be just less long, not short. In my world, short means, you make money when the price goes down, and that's not the case with short duration. It just loses less. And then the other problem I see with short duration strategies is many of these funds have very little interest rate risk but then they add a bunch of credit spread risk to the portfolios. So some of these strategies, they'll have, when you get into the acronyms, you have to be really careful, but they'll have, CMBS, which is commercial mortgages, or ABS, asset-backed securities, or CLOs, or CDOs, or RMBS, all sorts of credit acronyms. And to me, the whole point of fixed income is really to provide that diversification. So, very simply, if you own Apple stock and you own Apple bonds, do you really have diversification? Like having all that credit exposure is kind of the same beta to equities, because when equities sell off, credit spreads widen, bond prices go lower if they have credit risk. So I think advisors are solving potentially one problem, but they're adding a bunch of other risks to their portfolio.
And Nancy, I feel like because of all those acronym derivatives inside of these bond mutual funds and bond ETFs now, we haven't really had a real prolonged crisis. We haven't flushed them out yet. And my fear is that when we actually do have a period where there's stress in the credit markets and it is prolonged, too many retirees and too many portfolio managers that were counting on that protection, they're just not going to see it. And they don't have a great reference point for it yet, do they?
They don't. And I do think a lot of, I'm not a big fan of linear derivatives personally. Like those are all there are kind of two types of derivatives, linear, and then there's asymmetric. Linear derivatives are futures forward swaps, and they're commonly used in many of these 40 Act funds, whether they're mutual funds or ETFs. And I do think, you just have to know what you own, and you have to understand how these instruments work and be aware of the risks. And I think especially some of these short duration funds, I think they're solving one problem potentially, but then they're creating other issues that they might not want in their portfolio. So,
right. They make the fact sheets look pretty so that when the portfolio constructors are building their models, they go to bed at night thinking they have some protection that they might not have.
I think protection is just a dirty word in this industry. I think there's nothing, if anybody is selling you as a protection, it's probably like that's just should be a bad word that should be alienated from the industry. Like nothing gives protection. There are some things that may potentially work or seek to work in the future, but there are no guarantees. And that's why, having a diverse portfolio makes sense, because you just don't know what's going to work in whatever, pandemic's a perfect example. Like who knew this was coming, right? And nobody knows what the future holds, in my opinion.
That's right. So before we talk about your ETF, I've got to get your opinion on rates. So future rate hikes, are they currently priced into the market right now? And what are your thoughts on the yield curve? What do advisors need to be thinking about?
Well, hikes are being priced into the forward interest rate markets. It's kind of like, I feel like it's opposite day, because before with Yellen, nobody thought the Fed was going to hike, and they did hike. Now the Fed is saying they're not going to hike, and everybody's saying, oh, they don't mean that. And they priced in hikes. So it's definitely opposite day in the rates market, but the rates market is often not right. If you think about, let's see, December 2018, the rates market had priced in 3 hikes in 2019, and lo and behold, the Fed cut 3 times. So expectations don't always equal reality. But I do think it's a good opportunity, because maybe the Fed should hike, that's should and would are different, variables in my opinion, but I personally don't think the Fed is going to be hiking that many times before the next US election.
Excellent. Let's talk about your ETF.
Yeah.
So Nancy, every ETF has a story. Some of them really need to be told. I think IVOL is one of them. So we're going to talk about the process, the portfolio performance, but let's start with the history of IVOL. Tell us about its construction, how long it's been around.
So the fund is coming up on its 2-year birthday. It was listed in May 2019. It's an inflation protected strategy. Protection, again, soft word. We use TIPS as the core of the portfolio, which are treasuries with inflation protection. Around 85% of the fund is in TIPS, but then we add another measure of inflation and inflation expectations that's not linked to the consumer price index, right? That's the key thing is that TIPS, they are treasuries with inflation protection, but the index to measure inflation is just one index. It's sort of like if you own equities and you say, I own the Dow Jones, and boom, I'm done, right? There are a lot of different indices, there are a lot of different ways. And I think, the big problem that we see with CPI by itself is that a third of CPI is shelter. Shelter is mostly owner occupied rent. A lot of it is urban rent. It might not be the best or the only way to measure inflation. So we add on another measure to capture kind of the term premia, the risk premia, where interest rates are in the future, which is largely a result of investors' inflation expectations.
Excellent. And how are you capturing that specifically?
So we use the yield curve, and let me define what that is. That's just the difference at different points in time for interest rates, right? So in all countries, the central bank sets policy rates, but then the interest rates in the future are created by, different levels, different tenors of interest rates. So like if Jay, you were to lend me money, right? Like just very simply, right now, policy rates are, very close to zero. If you go to a bank and you open a CD, maybe you get 3 basis points, 5 basis points if you're lucky. If you lock up your money for 2 years, because very little Fed hikes have been priced in, you maybe get 15 basis points. And then if you say, how about if I lock up my money for 10 years, then you get paid, a little bit more, but it's still well under 2%. And that is, to me, another measure of inflation expectations is where lenders lend money.
Okay. So in the product, and forgive me, you're going to have to explain this to me like I'm 12 years old. In the IVOL product, you have TIPS as the core, and then you're using derivatives, options to capture some of this this inflation expectation in the future, correct?
Yeah. So maybe I can just give a quick segue on derivatives. Derivatives are like, it's like saying fruit, right? It's just a general type of derivative. There are two types of derivatives. There are linear derivatives, which are, make a dollar, you lose a dollar. It's a linear payout. And I don't care for those derivatives personally. I think, you don't really know what your risks are necessarily because you're not paying for something. Like it's sort of like a credit card where you get exposure to something, but you don't really pay for it. Because inflation, there is no zero bound with inflation, right? Inflation is one of those things that it's not like there could be deflation. The market can go negative. There is no zero bound. So we use long options, which are almost like a debit card where you pay for them and the fund can't lose more than the amount that you pay for the option. And then they have asymmetric payoff in case, that does happen. You have defined downside, at least with the option strategy. The treasuries, they do have unlimited risk, although they are treasuries. The options have that defined payout, which we like a lot because inflation is one of those things that's pretty slow moving. It can go negative. And it also has the benefit of whenever you buy an option, you are long volatility in the underlying asset that you own. So a lot of people, when they think of volatility, they think of like, the VIX or equity ball, anything with the options market has a volatility market. It's kind of like saying, is it a Kleenex or is it a tissue, right? Volatility options, it's the same thing. So many fixed income investors are actually short volatility, and that's because of the mortgage exposure. So mortgages, because the US homeowner can prepay their loan whenever they want, the homeowner is long the option. The owner of the financial mortgage is short the option. Therefore, mortgages are short volatility. So I think that's one of our, kind of things that we want people to be aware of is that most, like the Barclays Ag, about 28% is short vol from the mortgages. So it seems like, why would you only give your investors short volatility? You might as well offer something that also has long volatility. And that can have diversifying effects. Like for instance, in March 2020, TIPS were down, call it 175 basis points, but IVOL was up in that month. But it also continued to do well in the second quarter and the third quarter and the fourth quarter during the recovery. It's not like it's not a risk off trade. It's just because it's long vol, that piece can kick in at different times when you may need it. Hopefully I explained that well.
Yeah, no, I appreciate it. I'm not the smartest, so education is always helpful. And really, I'm trying to ask the questions through the lens of the financial advisor listening who has a fixed income component to their portfolio. And what this really provides is the opportunity to create some hedges in their fixed income portfolio. If I understand correctly, the ETF is going to give them exposure to tips with the majority of the portfolio and then these long dated options, correct?
Yes.
So then in a portfolio construction process, where does IVOL fit?
So I think it's funny because a lot of advisors who have IVOL in their portfolio, they have it as a pretty big weight, but it's more because they hate everything else more. So I think the more people hate fixed income, the more they tend to love IVOL. Literally we have some CIOs who have, cash and IVOL and that's it. And that's because they think, credit spreads are very tight and there's not a lot of upside, or they're looking at treasuries by themselves and are like, wow, the risk reward, it's more risk than reward at this point with the level of interest rates and the uncertainty. So I think it depends how much people hate fixed income, and the more they do, the more they tend to love IVOL.
Yeah, that's a great testimony right there. All right. So without getting into specific details around performance, you already spoke to how it did last year. Just kind of high level thinking about correlations. So how does this relate from a correlation basis to, say, high yield, the equity markets, and then traditional long dated assets or long dated fixed income, excuse me?
Well, the good thing about it is, at least historically, the correlations to other asset classes has been very low. For people who want to look it up, you can look at the IVOL ETF website, and we have the correlation numbers to equities and gold. We can run it on anything, but it's not, because there are different pieces of the components of the portfolio that can kick in different times. It tends to have a pretty low correlation to stocks and bonds, because it's not just stocks and bonds, right? It's something different. And I guess I've always been different in my life. And now it's a good time to be different, because you don't want, I think with any portfolio, you don't want to create things that all move together. And so we have a lot of model builders who they'll use it as a completion portfolio to the ag, because they want to add, a long vol and also inflation component to their portfolio. Or some people just like it because it's not like everything else. And who knows what future performance is going to be, but you can look at the historical and say, look, it's pretty different. There are not many strategies. I think the cool thing about options, long options, and please caution, your readers, whenever they see right is like a nice word for sell options. Sell options is sell vol. So anytime you see buy right, put right, call right is just a nice word for short options. That to me is quite dangerous, because you think about it, the day you trade, you collect a premium. That's the most you can make, and you just are hoping the option expires worthless. That's, it's kind of asymmetry in the wrong way. So you just have to be careful with derivatives. Have a bad reputation for a good reason, in my opinion. And you just need to understand what you own and what are especially in fixed income, because there's lots of stuff under the hood in many funds. Ours is pretty simple. It's just long options, cash, and treasuries with inflation protection.
Yeah, the funds with the prettiest fact sheets have a lot under the hood that's hard to understand. That's for sure. Yeah. Well, Nancy, I appreciate you coming on The Resilient Advisor, telling your story, talking about IVOL. For podcast listeners, please visit IVOLETF.com. That is IVOLETF.com. Nancy, I hope you come back on in the future.
Thanks for having me, Jay. It's great. I really enjoyed it.
Are you struggling to hold your team accountable? Do you struggle getting them to see your vision and drive results? The Resilient OKR System for financial advisors could be your solution. OKR is an acronym for objectives, which are your big inspirational goals, and key results, which are how you and your team are held accountable. This is the Silicon Valley method that drives growth at major companies such as Intel, Google, BMW, and Disney. Move your business results away from opinions and measure it with data.
Pick up your complimentary access to the Resilient OKR system for financial advisors by visiting resilientadvisor.com/OKR.